This is a very serious day when we really do need to reassess where we are with risk. In the eye of escalation, on a day like today, when you see these markets move, give me your first assessment to the energy complex, which is quite literally exploding higher. Crude up 4.33%. Let's start there.
Yeah, absolutely. Well, that is the starting point, as you say, to all of our thought process about how this is going to affect the global economy and, in turn, stock markets. The response today is a little more muted than I might have anticipated, actually. I think that does suggest that a full escalation is not in the price. But you're right. I think the way in which we need to think this through is, where do energy prices go? How much money does that take out of the pocket of consumers? How do policymakers then interact with that? Do they cushion the blow? Do the central banks not hike rates? Do governments provide subsidies to consumers to keep them spending? And then we can start to think about how that's going to affect growth and what the stock market should be doing. But you're right, the starting point is energy.
That's a heck of a decision tree analysis. That's a huge decision tree analysis. So let's take it up to the top of the decision tree analysis. An escalation of risk, invasion. We don't know what that escalation might be. I've seen various notes on real escalation of an incursion into Ukraine, a full incursion into Ukraine. What might that do to the upper bandwidth on oil and Brent in the first instance?
I think in that scenario, you could certainly see $120 oil. And I think what's really important for us to remember is this is not just oil. The importance of Russia in the global supply of many commodities, global fertilizers, for example, and how that affects global food prices. So I think we need to understand the starting point for the supply chain for a much broader range of the global economy purely than oil and gas. So, certainly higher energy prices from here, at least another 10% in that scenario. That's the starting point.
And on the softs, I mean, wheat, Russia is responsible for 25% of the global wheat exports and 20% of the corn exports, so which, again, double feeds back into the narrative of inflation. Look, escalation and inflation are probably hand in hand. But let's talk about the central bank reaction function, Karen. Still, the market thinks 25 basis points in March. The rates traders have not been moved by this escalation overnight. How much of a blockage would an escalation be to the Fed? JPMorgan calling for 9 hikes. Your own house calling for 9 hikes in a row. On the spectre of escalation, is that still remotely possible?
So the way the central banks will be thinking this through, or the playbook for central banks whenever they're facing a cost shock, is they'll say, is this in turn going to damage demand, slow the economy, and therefore bring down inflationary pressure such that we don't need to act? Or is there a risk of what they call second round effects? That is, rising wage pressures, which then add to costs and add to inflationary pressures. Are inflation expectations becoming de-anchored? Are they losing their credibility? And I think what the market is saying at the moment is there are risk of those second round effects. This is not a cost shock that's hitting weak economies. We are seeing, very low levels of unemployment. We are seeing wages pick up because companies are finding it hard to recruit and they're having to raise wages. So those risks of the second round effects, I think, are there for the central banks. It does differ by region, and hence you've got the ECB and some of the committee members there saying, well, we're not so worried about those second round effects. The labour market doesn't seem so very tight that we should be concerned about a wage price spiral. So we can sit with policy a little longer. In the UK and the US, I think the situation is different. The risk of those second round effects are more significant. And that's why at the moment the market is saying this may be a cost shock, but it's still something that central banks are going to have to react to. I think that's on these energy prices. We saw that scenario that you and I were just discussing, where we get another 10%, then I think we start to tip into that balance of this is going to be destructive on its own, and they would not want to be compounding that damage.